Hi, this is Shashank Mehta. I'm the founder of Equity Mat, a wealth firm based out of Mumbai. We help our end clients discover the right portfolio strategy that matches their investment temperament and recommend an asset manager who has a proven track record of running that portfolio strategy and delivering phenomenal returns. Today, here I am with Mr. Bhavin Shah, founder of Sameeksha Capital. Mr. Bhavin has a track record of excellence in equity research. The word Sameeksha is a Hindi word and it means thorough analysis to reach an accurate view. Sameeksha Capital has an extraordinary track record. The reason I say this is because over the past 8 years, they have a track record of investing into 30 multi-baggers. Sameeksha Capital's edge is not only to find winners, but also to spot laggards very early in the game. Sir, thank you really for this opportunity. And I hope we make the most out of this interview for our potential clients and existing clients.
Thank you for interviewing me.
Sir, let me begin this interview by asking how has been your journey? What is your background? If we could get a glimpse of Bhavin Shah's 30 years of journey, how did you think of forming Sameeksha Capital and Sameeksha's capital journey so far?
Yeah, so I developed an early interest in mathematics in high school years, and ended up winning a statewide Ramanujan Mathematics Talent Search competition.
Wow.
And interest in mathematics led me to study electronics engineering. But then during that process, I developed early interest in microprocessors. And I felt that no better place to learn more about microprocessor than United States. So I went for my master's degree in computer engineering, after which I got an opportunity to work with a team that was designing world's fastest microprocessor. So that was a defining experience for me because designing a state-of-the-art microprocessor requires a very strong discipline, very clear focus on processes and rules. In fact, one of my mentors used to say that paranoia is the safest frame of mind. It basically means that worry about things beforehand, and if you do that, the chances of mistakes later on are reduced. Beyond that, the interest was always there to return to India, and I had also had a parallel interest in equities. So I decided to pursue MBA first from IIM Ahmedabad, but then ended up finishing it from University of Chicago Booth School of Business, and that led me to a career in investing. Before starting Sameeksha, I'd spent 20 years analyzing equities, in particular technology stocks in Asia as well as at a global level, and then also set up India-focused institutional equities business under the name of Equirus Securities, which has been very successful. However, ultimately, and if I go back to doing an MBA, even in my business school essay, I used to write that I want to manage money in investment in equities in India. So I wanted to kind of basically fulfill that dream, and that's where Sameeksha came about. I was already approaching my the age of 50, but I felt that when I look at some of the legends like Warren Buffett or Charlie Munger, they kept working well into their 90s. In fact, Charlie Munger, till his last, just under the age of 100.
Yeah.
And that told me that even from the age of 50, I could have a very long, I can take a very long-term view on this, on the idea of focusing purely on investing. So basically, I took an all-in bet. Put everything I had, in equities into Sameeksha's PMS, and started Sameeksha with me being the first client. The journey of Sameeksha has been, obviously, as a startup, fairly challenging. Especially going through the rough periods in the market during 2018-19 timeframe, and also building a client base. But I was fortunate that one prominent industrialist put faith in me, and invested a very large sum upfront. That investor is still with me, and his money has, I think, grown about 7x in a period of just under 9 years.
Wow.
So I think the idea behind Sameeksha was to focus on investing, managing my own savings as well as others, but do it in a way that you do it using the principles and methods that I had learned over prior 20 years of experience in doing equity research in technology and then India on a broad basis. Working with some of the finest minds in processor design helped me to not only earn two US patents, but also develop respect for rules, processes, attention to details, and teamwork.
Wow. Thank you, sir, for giving such an elaborate answer. I could actually visualize you writing your essay paper in your MBA days, and 3 decades hence, you're able to really get the dream going. So for our end clients or investors who are looking for portfolio managers where the founder himself is involved in buying and selling decisions. In Sameeksha Capital's case, Mr. Bhavin is not only the founder but also the CIO. He is deeply involved in the investment process, buying and selling decisions. Also, importantly, he uses the same machinery to manage his own capital. Sir, can you please highlight top 3 learnings of Sameeksha Capital in this journey that you believe would have enriched your investment wisdom? And also, sir, as a follow on, if you could help us learn what is your vision for Sameeksha Capital over the next decade?
So I think, if I can think of top 3 learnings, the first one is the strength of the business model and the growth opportunity. These are the two forces. When they combine, they multiply the effect, and and you end up seeing amazing outcome in terms of investment returns. A second is that if you have done enough homework on a company, don't lose faith. Yes, keep analyzing, keep reviewing what is happening. But if for some external factors or the factors which might be temporary, the stock doesn't perform, don't lose faith, because in our experience, almost every single I should say vast majority of companies that we have invested have eventually delivered phenomenal returns. Sometimes we lost faith and we gave up, but had we stuck to them, they would have eventually rewarded us. So do all the homework upfront, but after doing that, have a faith in the company. Third thing I would say is that investment is is a continuous learning process. So we keep reviewing the investment framework, or more importantly, the rules and processes that we follow, and analyze our past investment decisions and try and see what we can modify. So I would say those are the 3 main learnings for me.
Okay.
As far as a vision for Sameeksha, I think I intend to do this as long as I'm mentally and physically able to do. We don't have any specific asset under management targets. We are not here to gather assets. We are here to manage money in a way that is rewarding for us and, more importantly, rewarding for investors. In other words, delivering value to investors, delivering outperformance and alpha to investors. Basically, meeting the expectations of our investors. That is the most important vision I could say we have, and that's what we come here to work every day.
Sir, what is Sameeksha Capital's perspective on India listed equities? How do you see the India story versus the opportunities that are available in global equities, especially for NRI clients? What would really make them go for the India opportunity even today versus what is there in, let's say, US equities or other global equities?
So I have been an NRI myself, and I also have analyzed companies outside India, as I mentioned earlier. So I think I'm probably in a unique position to address this question. I remember going back to year 1996 when I had first analyzed markets around the world, along with Michael Mobison, my colleague in US at Credit Suisse, with the following objective. In which countries are there a good pool of companies generating superior return on capital? Number one. And number two, in which countries is this measure well understood by the market? Surprisingly, India stood out along with US. Now, if you look at the equity returns of these two markets between 1996 and today, these are definitely the two best performing equity markets in the world. So there is something about India that has been in place for a long time, and we believe that that's continuing. And what is that thing? I think India is blessed with a very deep pool of top quality management talent, people who understand the importance of return on capital and shareholder value creation. And that's why we always have had a great set of companies to choose from. Now, the growth for those companies may vary from time to time. Economic environment might affect their growth and so on. But India has always been a great place to invest. And I think that past data proves. And I think when we look at the future also, we are today at $2,500 GDP per capita. We have a favorable demographics, young, population, and a lot of effort by the government to create productive capacity in the economy. And one thing that has changed about India in last decade or so is an amazing startup ecosystem. You name a venture capitalist, he is there in India to basically fund bright young entrepreneurs working on a new idea. So that also creates a steady flow of new ideas and new set of companies that get listed. So it's a very vibrant market, both for existing companies delivering phenomenal performance, as well as a new set of companies that come to the market. So as we go from that $2,500 GDP per capita to maybe something like $12,000, $15,000 GDP per capita, it's really a 20, 25-year journey from today onwards. And that gives a very long horizon for investing. And I don't think there is any other market I can think of that offers an opportunity like that. Obviously, US is another great market to invest for reasons that we are aware of. But I think outside of US, India continues to be the most attractive market in our view to invest. The other thing about India that is interesting is that in terms of corporate governance standards, India has ranked pretty well historically as well. So I think that while we have our own set of challenges with respect to dubious companies and so on, there is also a good set of companies that follow top-notch corporate governance. So I think all in all, I think India is, if somebody is deciding where to invest in the world, I would say, US and India continue to remain two most important markets.
Wow, thank you, sir. Sir, they say that philosophy is the glue that holds everything together. What is Sameeksha Capital's investment philosophy? What does it mean to you? If you can highlight some of the guiding principles.
So, you start with the word Sameeksha, it means careful analysis. And doing careful analysis means, it requires a lot of work. So first thing that we believe, that I've always believed, right from, starting Credit Suisse, Asia Tech Research, all the way to Sameeksha, is that upfront investment in the right resources is very important. So we have always invested in people ahead of our size, ahead of our revenues, without worrying too much about profitability. We believe that that investment eventually pays off, and it has so far. And so we continue to invest heavily in resources, which is people. Second is that to implement our approach to investing, we have created a set of rules, set of processes that we want to follow in a sincere way. And to follow them, we also deploy technology. And and while deploying technology requires some special tools, some special techniques, and for that we have in-house software development. So in that way, we are very unique in our industry. Very, very few entities like us would have in-house software development. We're very proud of our in-house software development capabilities. Now, we have been writing in our information deck for investors that investing is not entertainment for us. Most of the time, it is doing very boring, tedious work. Interestingly, we found a similar quote by one very successful investor. He said, "If investing is entertaining, if you are having fun, you are probably not making any money." So we completely agree with that. Doing investing is a lot of hard work. We have very elaborate checklist that we have to follow. And so, that is a process that very, very few people enjoy. We are lucky to find such people who join us, and the successful uh, research analysts that work with us end up basically embracing our process, and they also actually help us modify them and improve them over time. The other thing is that we respect the market. I remember a quote by Professor Raghuram Rajan, the former governor of RBI. He once said that if you see a pot of gold lying on the street, first question you ask is, why has anybody else not picked it up? So while when we see opportunities in the market and we find something undervalued, we ask a lot of questions. If we invest in a company and the stock is not performing, then we ask more questions, that why is that happening. So we respect the market. Having said that, we look for opportunities that are unrecognized by the market, uh, and I think that is where doing detailed work actually helps you, because by you can hear a lot of reasons why this stock is cheap. When you talk to other investors, they will give you a lot of potential reasons. But when we go deeper into it, and when we kind of address those reasons, then we can develop conviction that despite those reasons, this is actually a genuine value opportunity, and that actually results in a very successful investment for us. And the last thing I would say about philosophy is integrity. And to us, integrity is core of at the heart of everything we do, and it is about doing the right thing even when nobody is watching. In one of the places where I can point out is in the calculation of fees, performance fees in particular. We have seen, we have been now doing this for all 9 years. We have seen many variations in the ways in which performance fee is calculated. And if we found that something that we were doing was not fair to investors, we have modified our method. And today I can safely say that the way we calculate performance fees is comparable to the best in the market in terms of fairness to the investors. And I think so. And this we have done on our own. We have recently also decided to modify something in favor of the investors, because for example, we believe that in future, as index funds become more available, investors would have a choice of investing in an index fund. So we are trying to link our fees such a way that if the investor returns should not drop below index returns. So I think integrity is at heart of everything we do. I think as we don't have any side pockets. I don't run a private portfolio of stocks. Everything that I have in direct Indian equities is in the Sameeksha's PMS or AIF.
Thank you, sir, for explaining to us Sameeksha Capital's investment philosophy and the guiding factors that you follow. Moving on, if you could explain to us what is Sameeksha Capital's investment strategy. I believe that one of the things that Sameeksha Capital looks into are companies that are undergoing significant transformation, but are not on the radar of many investors. If you could elaborate this by giving an example and even some other thoughts on investment strategy per se.
We are predominantly focused on the India growth story. And so we look for companies that are participating in India's growth story. We believe that India has a very long runway for growth. I think I mentioned earlier that we have maybe 20-25 years of runway for growth, high growth, that is. And which of the sectors and companies can take advantage of that, which companies have strength in their business model to capitalize on that. Now, what tends to happen is that when we invest, we have a very strict investment criteria that the expected return over coming 2 to 3 years, which is our investment horizon when we start, should meet or exceed our minimum required rate of return for a given business. And that minimum required rate of return depends on the volatility of the business in terms of the earnings, cash flows more importantly, and also the liquidity, the trading volume in the stock, how difficult is it to buy and sell the stock. Those two factors affect our minimum required rate of return. So we would buy a stock only if after doing all the work, we find that the stock is available at a price from which we can meet that condition. So what it does is it pushes us to look for companies which are not yet fully appreciated by the market. Now, they might be not appreciated for multiple reasons. First could be that let's say recent listing, it was an IPO and stock is recently listed, so maybe not many people have looked at the company in great detail. Second could be that it just happens to be a relatively small company, so doesn't have as much active coverage from sell side, and it's not on the radar of some mutual funds and so on. And third could be it could be a small or a large company that is going through transformation, and the market is for various reasons not willing to reward the company for that transformation. The transformation has to happen for the market to value it. So I think we have found great opportunities in all three buckets. So in the first bucket, the name I can think of, is like, for example, Polycab, which, post listing was trading at a very reasonable valuation. I think there were a lot of concerns about the company, in terms of the quality of the management and so on and so forth. We did our homework. We talked to, some other competitors of Polycab. We talked to some distributors and also talked to the company itself. And we were convinced that this company is going to deliver phenomenal results. And we invested in it. It also met our criteria for the required rate of return. It turned out to be a very good investment. Another example in a similar category would be Anand Rathi Wealth, which, I think there were a lot of negativity around the business model of the company in the marketplace. But we actually delved deep into the business model, and we felt that this company actually has a very unique business model, and they have some competitive advantage that is going to be very hard for others to meet or copy. And it was available at a great value, and that's why we invested in the name. When I talk about companies that are like going through transformation, another great example would be ICICI Bank. It was trading at a meaningful discount to HDFC Bank when we looked at it. That's when the company had gone through the change in the main leadership, as well as for example, the whole episode that happened about 5-6 years back.
Yeah.
And the new management had came out and laid out the strategy, which was focused on generating superior returns on equity. Creating. In fact, the strategy required change in culture in terms of the way the bank was run, and it all sounded great, but whether or not it's going to happen. So we did our own work. We were fortunate to also talk to the company and discuss this, and then we observed how this was playing out for 1 or 2 quarters, and we saw that things were beginning to happen, and that's when we actually invested in ICI. In fact, it was pretty much not exact switch, but around the similar time, there were issues with HDFC Bank with respect to its technology, and there came a ban from RBI on credit cards. And that switch worked out extremely well for us, because ICICI Bank not only delivered growth but also saw re-rating. So there were 2 factors driving the share price improvement, whereas HDFC Bank got massively derated. So I think this is kind of the examples that I can think of in terms of the kind of things that we like to invest in.
Thank you, sir. Thank you for explaining your investment strategy and thoughts, and even giving corresponding examples. I think it will really help investors to know better about Sameeksha Capital's investment strategy. Sir, at Sameeksha Capital, how do you shortlist stocks, and how does a shortlisted company become a portfolio company? Essentially, idea generation to idea selection. In other words, when does Sameeksha Capital press the buy button?
So, we have a universe of, I think it's more than 1,000 stocks, for which we have created our financial model, and those are automatically updated for quarterly results.
Wow.
Using our in-house technology. So at any given point, we have that universe, with the latest financial data available to us, on which we can run various screens. And from time to time we run this screen. We run this actively during the result season. We identify, the software tells us which companies have reported interesting results. We have fed some criteria to the software. So it tells us that these are the companies that have come up with interesting results. And then the relevant analyst would decide, basically, whether he wants to or he or she wants to work on that company, giving reasons. And if approved, then they can go and do some more work on those companies. In addition, when there are some significant market movements, for example, recently we had a big correction, we would go and rerun our screens to see if something else has become interesting. Apart from that, we find huge value in interacting with other investors in the market who we think are doing good job. There are many. We attend investor events, conferences, and there we might come across company or discuss company. We look at IPOs, though we don't really invest directly in IPO in the PMS for very some technical reasons. We definitely look at every single IPO as much as possible, to see if there is some potential company that we could invest in once it gets listed. So there is and then obviously, you kind of observe something, come across, it's like what I call Peter Lynch moment. You use some product or service and you thought, what about the company? This company, is it listed? What about, investing in that company? So that can also happen. So a short list of ideas, if I can say so, is generated using all these various means. And that list is then, prioritized, based on the potential attractiveness of an idea. And then we do a hierarchical approach to our analysis. We call ourselves in a business of eliminating ideas. Because, very, very few companies are going to meet our investment criteria. So we first do what we call market implied valuation. What is market telling us about the value of this company? The kind of growth, the kind of profitability that market is implying, is it realistic or unrealistic? So if it looks like it's something completely out of our zone, then we would put that company on the hold. But if it looks interesting prima facie, then we'll go into our first level of work, which is building a particular details of financial model, and going through our checklist. We have a very elaborate checklist comprised of questions that we like to ask about a whole different aspects of a business, qualitative and quantitative, the past track record, corporate governance, management quality, business opportunity, competition, and so on. And we would, so the relevant analyst would do that work, build financial model, and come back with a view that would be presented to the entire research team and the investment team leaders. And they will receive some feedback, and they'll go back and finish that. And at that point, we have some initial idea of whether or not we want to invest in that company. In some cases, we have enough information to start investing, and then we might do so. In other cases, we say that we need to do detailed work, further work. So then there is another level of list of questions that we pursue. We try to also scope out the industry in detail. What is the industry growth opportunity, and how does it fit into this company? And we complete that. Obviously, in this entire process, there will be interaction with the management. That goes without saying. It can happen once, multiple times if required. And we are fortunate that based on the name that we have built in the market, we are able to get access to most of the companies and their management. And when the process is complete, and if the stock meets our investment criteria, as I mentioned earlier, the expected return over next 2 to 3 years, is it same or above our required rate of return? And this we derive using what I believe is the most robust valuation framework, which is discounted cash flow analysis. And if it meets our criteria, then we would consider investing. Now, apart from deciding to invest, we also then need to decide how big a position we want to make. And there we bring in a whole new set of risk management rules depending on the liquidity in the stock, we would decide how big a position we want to build. If it's a illiquid stock, we would restrict ourselves to small positions. If it's a very liquid stock, we could build a much larger position. That I think has worked really well for us, because there are times when we make a mistake, and in fact, as it turns out, if we realize we have made a mistake and we want to exit, uh, if we build a large position in small cap, it would be impossible. So I think while we might have uh, left some money on table, maybe by not building large positions in some small cap, I think overall it has worked out very well and is reflected in our uh, very strong performance in down markets. Our downside capture over last 5 years is just around 50%, which I believe is perhaps among the best in the market, even compared to some of the best name mutual funds.
Thank you for such an elaborate answer again, sir. It really helps incoming clients understand how detailed is the process for a shortlisted company to become a portfolio company. And also, I believe there is like a 120-point checklist that Sameeksha Capital follows.
Yes.
Sir, at Equity Math, what is really at the core of our principles is to help clients understand the importance of holding on and doing follow-on buying under the guidance of a portfolio manager. So at Sameeksha Capital, now that you've explained us the investment process, portfolio construction, how different is it to construct a portfolio for a new incoming client? And what does Sameeksha Capital do when such a client who is an existing client continuously does add funds for follow-on buying, of course, under the guidance of Sameeksha Capital?
A few important things about our portfolio strategy that I would like to say in the context of this. One is that, as I explained earlier, we only buy stocks that meet our investment criteria. If we don't have enough investment ideas at any given point in time, money can stay in liquid funds as long as, till the time we find some interesting investment idea that meet our criteria. And other important thing is that we do not follow what is called a model portfolio approach. In other words, when a new investor, comes in, brings capital, or even an existing investor adds capital, we do not replicate our existing portfolio or portfolio in our existing set of clients in this new account. We would only buy stocks which are currently available uh, at a price that meet our criteria. So the new portfolio may only have a subset of stocks compared to, say, an old portfolio. However, what can happen over time is that we may find new ideas, so which we would buy in across all the accounts where cash is available. Uh, we might in the older accounts, let's say we might decide to sell some stock, and basically that will create some cash, and so it may be bought in the old account as well. But essentially, what will happen is over time the old and the new portfolios may converge, but there is no forced convergence. And second, there is no time specified in terms of how long it will take to deploy capital in a new account. Sometimes it could be rapid if the market opportunity is such. Sometimes it could be slow as well. So, and then as far as the investor adding money in an existing account, same philosophy applies. And we do this using set of rules, and these rules are coded. We have in-house software development, something that I mentioned. Our entire PMS operation is run using in-house software, and in there we have basically put in place rules that are followed to generate trade instructions. So, for example, we like particular stock, and we want to create a particular position size. The software will calculate how much to buy in each and every account based on cash available, and that's how the trade order is generated. So it is all done using very well defined rules, whether it's a new account or old account. The other thing I would say is that in an extreme situation, we might even take a cash call, which is that if we feel that the market is at a risk of a major correction, and that correction may not resolve itself in a relatively short term, or we don't know how it will be resolved, then we might, to protect the portfolios, we might take a cash call. And I think the biggest cash call we took was at the start of COVID. We went from being fully invested to 35% cash in a matter of few days. So I think that's sort of how the portfolio construction works for new account as well as an existing account which might be adding cash.
Understood, sir. So, in effect, because Sameeksha Capital follows an individual portfolio strategy, they essentially would build a portfolio or utilize funds basis the timing at which these funds are made available to Sameeksha Capital and basis what opportunities are best available in the market at that point in time.
And I think one of the things that we have seen as a result of this is that at least historically, uh, we have been able to deliver value to our clients irrespective of when they joined or when they funded their account.
Sir, very few PMSs in India might be using technology the way Sameeksha Capital uses. I got to learn about your proprietary software called RAW. I also got to learn about the fact that all your earnings and financial models for all the companies under coverage are updated automatically after every quarterly earnings season. Could you elaborate a little bit more on this as to how are you using technology to research and portfolio management?
So, RAW, you mentioned RAW, so it stands for Research Automation Works. So, essentially, we want to automate whatever steps can be automated using technology. Because, we do a lot of repetitive work. There's a quarterly result every quarter, for example. We have identified and we are continuously identifying how can we use software and technology to basically make our research more efficient, time efficient, and also take out the repetitive and mechanical aspects of work. Obviously, of late there is a whole talk about Gen AI. I would say we are still in the early stages of deploying Gen AI, but we have had some success in using Gen AI to essentially categorize the notes that we take into relevant subfields. In fact, that brings me to an interesting point that everything we do, we document everything we do. We talk to a company, we take detailed notes. And by categorizing these notes, we should be able to look at the past, history of what company had said different point in time about different topics. And I think so when we are reevaluating a company that we had looked at before, it helps us get up to speed relatively quickly. The detailed, valuation framework essentially means trying to apply a cash flow or a cash flow equivalent method to valuing a company. If it's a financial company like a bank, we might use excess ROE. If it's an insurance company, we might use the embedded valuation and concept and so on. But ultimately, we want to get to the intrinsic value of the company based on reasonable long-term assumptions. So making reasonable long-term assumptions is very important. And for that, we have created a macro model for India. What is the India's economic growth potential over next 20, 30 years? Within the context of that, we create an industry model that XYZ industry, is today this big. In a country that has developed before India, let's say China, that industry is this much. As India, sees that growth in GDP per capita, this industry can go from here to there. So that creates that, roadmap for growth for the industry. And then we tie the company into that. This company has this kind of a potential, this kind of capability. So in this industry, they can gain market share, they can maybe maintain market share, and sort of that's how the growth assumptions are derived. And then we go into the profitability and return on capital. What is the genuine potential for this company to deliver on that? And I think all that together, comes into a final sort of intrinsic value that we get for this given business. And then we apply our criteria, whether or not it is worth investing based on that. I think technology kind of, runs deeply into everything we do, whether it's research or whether it's operations. And we will keep trying to find a way to use technology to make our work more efficient and stay relevant.
Sir, they say that for successful investing, three things are required: philosophy, strategy, and portfolio discipline. Sir, if I may talk about portfolio discipline, what is the number of stocks that Sameeksha Capital has typically in a portfolio? I had read it in your presentation that while it is concentrated, but it is sufficiently diversified. And also, sir, as a follow on, if we may try and understand what is the max weight that you generally allow for a certain stock or a sector to have.
Yes, so let's look at this from multiple important point angles. We are, first of all, we are a multi-cap fund, so we invest across market cap. Um, now one of the things that we observe is that as we go into the small cap bucket, the liquidity can be a challenge, both in terms of buying and selling. And our philosophy is that we do not want to, impact the share price as much as possible because of our buying or selling. So, based on the liquidity in the stock, we would set a rule of maximum position size in that stock. And then we also want to allow only a reasonable time to build a position. I think we are fairly flexible in that. We could allow as much as up to say 6 months to build a position, and within 6 months. And ultimately, we don't want to have very very small positions in any name. So we do want to run a concentrated portfolio. So when you combine the desire to have a concentrated portfolio, because we believe concentrated portfolio is important to delivering alpha. So the desire to have a concentrated portfolio, and also to not have in unreasonable length of time to build a position, those two things when we combine, it creates an upper limit on a stock that in terms of position size that we can have. Ultimately, having a too small a position is also not desirable. So that creates a lower limit on the position size that we can have. So both of those factors kind of create the boundary conditions within which we can play. And if it's a liquid name, we could take very large positions. We could go as high as 15%. Though of late we haven't had any instance of doing so because we have found multiple opportunities in the market. So what from our experience and based on our size today, what we feel is somewhere around 35 plus or minus few number is a reasonable position, is a reasonable number of stocks that we can own. And it is a larger number compared to some other PMSs because of this rule that we have on the position size and the small cap. We end up having a larger number of small cap names rather than having few very very small number of small cap names. And we would revisit that number in future if we feel that it becomes necessary. As I mentioned, the largest, we could go as high as 15%, but on the lower end, we would like to have at least say a 2% position. Sometimes we end up having with even a lower position because we start buying a stock and it goes up and it's no longer available at the price that we like to buy. So we may end up with a smaller position as well. We also may try to build a position by sourcing a block if our conviction is very high, and if we can find a block in the market for the stock. The other relevant rule for our portfolio construction is the liquidity in the portfolio. As I mentioned in one of the other questions, that we want to have the flexibility to take a cash call. Now, cash call is only possible if we have some liquid names in the portfolio. So we have created rules around how much of the portfolio we should be able to liquidate within one day, how much within say a few days, and how much in a longer period. So when you combine these rules related to the exposure of the portfolio based on the liquidity and the rules around position sizes, it kind of create those boundary conditions, and when you then add the number of stocks in the portfolio, 35 to, plus or minus few, it kind of guides how our portfolio construction works. And by the way, all these rules, going back to software, the software we have for running our portfolio operations, these rules are hard coded in the software. If we are violating any of these rules, the red warning, red flag message comes out that you are violating this condition. So so that we are aware that of where we are with respect to this risk management rules. I believe that these rules have played an important role in, again, going back to the point about downside protection. The low downside capture that we have. I think these rules perhaps have helped us because we have limited ourselves to not building very large positions in small cap names.
Wow. So, sir, I believe that Sameeksha Capital is doing rule-based risk management for real.
Yes, it is. It is. And I think that runs across everything we do. If we say this is what we do, we actually do it. And if we believe that we can't do it, then we will say we can't.
Sir, while you've explained the portfolio construction process, when a new client enters and at inception how the funds are deployed, if we can go just one step deeper into when you identify a stock that needs to become a portfolio company, how do you build the weight in that stock? If it's available at desired valuation, do you go at it at a single go, or do you still follow time diversification?
Generally, we would try to build the position uh, gradually, unless we believe that the market is extremely oversold. When we run some, we have our own market monitor. We run various, formula to see how the market as a whole looks to us in terms of valuation. We have something called Sameeksha ratio, which is basically taking into account the price to book for the companies and the or the index as a whole, and versus their return on equity and so on. So it gives us a fair idea of where we are in terms of the overall valuation of the market. If market looks super attractive overall to us, or maybe the pessimism is really high, and we are actually more convinced about the long-term outlook, we may build positions very aggressively and very quickly. However, if we are in sort of a relatively frothy environment of a market, we would try to do a little bit of time diversification in terms of building a position. So it depends on how we feel about the overall market, and also overall about the particular opportunity as well. If the conviction is super high, we might be far more aggressive.
Okay, so in some sense, Sameeksha Capital does make a sincere attempt to time the market using various ratios and quant parameters that you track on the broader market as a whole. Sir, at Equity Math, we generally encourage our end clients to see a portfolio manager from a very, very long-term horizon, like appoint a portfolio manager like literally for maybe 10, 20, 30 years. But to capture full potential of Sameeksha Capital's portfolio strategy, what should be the ideal time horizon? Should it be 2, 3 years, or should it be longer, given that Sameeksha Capital's portfolio has a meaningful exposure to small and mid cap?
First of all, the exposure to small and mid cap can vary from time to time, but there'll be always be some exposure.
Okay.
Because I think it is going to be very rare that there are great opportunities in large cap, but none in small and mid cap. So and the percentage return potential tends to be generally higher in small and mid cap. So we are always going to have some small and mid cap. That is one thing. Second thing is that market goes through its own gyrations, and we are not the best in terms of anticipating some of the movements of the market. So our request to investors is to give us 5 years. I mean, at least 3 years, but ideally 5 years, because if that is a long enough time for us to capture the opportunities, to correct mistakes that we might make, and in the end deliver results. In fact, if you look at our track record, there has not been a single 5 year period, rolling 5 year period every month that you can measure, and we have completed, I think, about 47 5 year periods by now. There is not a single 5 year period where our performance has been outside of top 10% among all the multi-cap PMSs.
Wow.
And there has not been a single 5 year period in which we have not delivered alpha. And I think our median alpha is something like 6-7%, the returns over the benchmark. So I think we do request investors to give us a bit of a time. I think I've seen that there are times when, because of the way we invest, sometimes we are not aggressive in deploying new money. And if the market rallies very quickly against our expectation, then some new accounts might even underperform. And we had that period. But I think the investors who showed patience with us eventually saw that their portfolios eventually started to perform and outperform the market. And I think, yeah, we request investors to give us a bit of time.
Sir, during the course of research, there many companies seem as good opportunities. I believe I had read in a presentation that Sameeksha Capital has a very out-of-box approach to identify red flags. Sir, if you could give us a few examples of what is this out-of-box approach and how Sameeksha Capital was able to avoid or dodge or navigate from some of these opportunities which could have been potential traps.
Yeah, so I think one is the way we run our checklist. It basically forces us to think about all possible things that can be wrong about a company. Second is that the checklist is not just a formality, right? And I'll give you an example. We were analyzing one pharmaceutical company in a small cap space, and we were kind of intrigued by the name of their US subsidiary. The name didn't sound right to us. So we decided to probe into it further. And that US subsidiary ended up being kind of a dummy company. And the main person for that company, we did some digging into the US filings, and we found that the owner or the main person running that company was a grocery store owner in Missouri in the United States. So that was a clear red flag for us. In another case, some potential issue with a plant of a particular company, and we felt that the management was not exactly telling us the truth, or we are not sure whether they are telling us the truth. So what we did is one of our analysts flew unannounced, from here to a city in South India, and then traveled for a few hours to reach the plant. Obviously, he didn't have the permission to enter the plant, but by talking to the people outside the plant, there was a shop. He talked to there was a like a general store. He could find the information that we needed about what was happening with that plant, and that was enough of a message for us to not invest. I think the other thing is just doing what we call channel checks. I think the story of Yes Bank is known to many. There was a time when it was considered a very successful bank. Numbers were great, but our analyst did not was not convinced. He spoke to some employees through various means, and learned that the company was not correctly reporting the non-performing assets, and eventually that came out, and we know what happened to US Bank. So basically we are trying to avoid major disasters in the portfolio. I think, as I mentioned in one of the other questions, that our job is to reject as many companies as possible, and I think we try to uh, deploy whatever it takes to find out the truth. What exactly is the story of a company.
Under what circumstances do we exit a portfolio company? Could be a part exit or could be a full exit. In other words, when does Sameeksha Capital press the sell button?
So I think in a normal course of things, after we invest in a company, we're tracking the developments with respect to that company, and at any given point in time, we have the price below which we would like to buy that stock, and price above which we would like to sell the stock. So we are investing with a 2 to 3 year horizon, and we have a target price in mind 2 to 3 years out. Now, if our investment has gone well, it is very possible that that target price is achieved far in advance, or it is achieved closer to our target date. And we are constantly setting a forward-looking price target, which means that we have an expected return at any given point in time for next 2 to 3 years in a given stock. As long as those expected returns look favorable, look meaningful, we would stay invested in a company. However, the expected return, let's say, diminishes to a very small value, then we would consider exiting the stock. However, we don't want to generally rush the exit based on some past experience of selling, some winners too early. If there is enough business momentum, we would like to sort of do our exit in a gradual manner. Maybe trim the position a little bit, and and keep evaluating, and then try and complete the exit if required. Or sometimes, we might keep a smaller position as well. The other situation could be that we made a bad investment decision. We would evaluate what has gone wrong. Is it a mistake in judging the quality of this business? And in other words, it may not be that something that is going to correct over time. And then in that case we try to exit the stock. We may not be able to exit as quickly as we would like to because of the liquidity in the stock, but ultimately we will want to exit such names. So I think those are generally how we follow the process of exiting a name. I think there are names that we have held for a very, very long period of time because they have always looked attractive from a incremental 2 to 3 year perspective, and there are names which we were completely exited as well. And once we exit, we can always revisit if the price corrects or there is a time correction.
Sir, at Equity Math, we generally encourage clients to track what is the fundamental progress in a company. Could be TTM PAT growth, could be EBITDA margin expansion, revenue growth, volume growth, etc. While tracking the portfolio market value is possibly the easiest thing to track, we genuinely encourage clients to also remain updated on what's happening in companies at a fundamental level, so that they can maintain composure even during volatile times. So, what does Sameeksha Capital do to help its clients remain updated on their portfolio companies on a fundamental level?
Apart from client having access to their account online, we also send out a quarterly update on our portfolio, and that covers broadly what are the companies in the portfolio and what are the fundamentals of those companies. And then I think we also publish an annual letter in which we kind of cover how the year went by and what worked for us, what did not work, and that also kind of goes into the portfolio a bit more. And finally, we also I think maybe I would say about twice a year we do an investor call.
Okay.
Investors can submit their questions beforehand or through live chat during the call, and we try and address all the questions that investors have through that call.
Sir, I would really like to thank you for explaining the entire gamut of operations that are being done at Sameeksha Capital to generate optimal CAGR for client capital. I really appreciate on every point that you've elaborated using examples. I really admire proprietary software that you've developed, processes that you've instigated. Really thank you for this interview, sir. And I hope our incoming clients watch this and get to know, literally everything from the horse's mouth. Thanks again, sir.
Yes, thank you, and I hope that prospective clients find this useful.
Thank you, sir. Thank you.